Want to know the secret strategies of the world's most successful investors? Discover how billionaires like Buffett, Musk, and Soros made billions by thinking differently. Don't miss out. Buffett's patience. In the world of investing, Warren Buffett is a name that commands respect. His strategy is simple but powerful: patience. Unlike most investors who chase quick profits, Buffett has always believed in the power of long-term investments. One of his most famous quotes is, "The stock market is a device for transferring money from the impatient to the patient." In 1965, Buffett took control of Berkshire Hathaway, a struggling textile company, and began his journey to create an empire. Over the decades, he made strategic investments, choosing companies he truly believed in. By sticking to his philosophy, Buffett transformed a failing company into a multi-billion-dollar conglomerate. His secret? Patience. He didn't sell his holdings at the first sign of trouble. He waited, often for years, allowing his investments to grow and compound. It wasn't about making money quickly, but about making money consistently. Today, Buffett's wealth is the result of decades of smart, patient investing. The world's most successful investors owe a lot to his method of waiting for the right opportunities and sticking to them, no matter the short-term market fluctuations. Dalio's transparency. Ray Dalio built his fortune not just on smart investments but also on radical transparency. As the founder of Bridgewater Associates, the world's largest hedge fund, Dalio believed that the key to success was creating an environment where everyone could speak openly and honestly, even about the most uncomfortable topics. In 1975, Dalio started Bridgewater from his apartment, and over the years, he developed a set of principles that would guide his business. One of the most important was his idea that open communication, even about mistakes or failures, was essential to growth. He encouraged his employees to challenge ideas, even his own, to improve decision-making. Dalio's focus on transparency was not just internal. He applied it to his investments as well, making decisions based on thorough research and insight. This approach helped him predict the 2008 financial crisis, which made him billions by betting against the housing market. Today, Dalio's principles remain a cornerstone of his investment strategy, showing the world that success is about more than just the numbers. It's about how you approach challenges and decisions. Musk's risk-taking. Elon Musk is known for his bold moves and unwavering risk-taking. The founder of Tesla and SpaceX doesn't shy away from challenges, and his ability to make high-risk decisions has been crucial to his success. In 2004, Musk invested $6.5 million of his own money to fund Tesla, a company struggling to develop electric cars. While most investors were hesitant about the future of electric vehicles, Musk saw it as a revolution in the making. He believed that investing in renewable energy and electric cars could change the world. At the same time, Musk invested in SpaceX, his aerospace company, aiming to make space travel more affordable. His risks paid off when both companies reached new heights of success. Tesla revolutionized the auto industry, and SpaceX became the first private company to send a spacecraft to the International Space Station. Musk's strategy is clear: without taking risks, there's no chance for groundbreaking success. His story reminds investors that sometimes, the bigger the risk, the bigger the reward. Soros' reflexivity. George Soros, a name synonymous with market theory and high-stakes investments, is best known for his theory of reflexivity, which reshaped how investors view the market. In 1992, Soros famously broke the Bank of England by betting against the British pound, making $1 billion in a single day. Soros believed that markets are not always rational. According to his theory, market participants don't base decisions purely on facts. Instead, they act on their perceptions, which can influence the reality of the market. This feedback loop creates opportunities for investors who understand the system. Soros applied this theory in real time, predicting bubbles and crashes before they happened. His insight into the irrationality of markets helped him make huge profits during times of economic turmoil, like the Asian financial crisis of 1997 and the global financial crisis of 2008. Soros' strategy was to see beyond the conventional wisdom, knowing that market movements were often driven by emotions and misperceptions. By understanding these forces, he became one of the world's most successful and controversial investors. Icahn's activism. Carl Icahn, a legendary investor, is known for his activist investing strategies. Rather than simply buying stocks, Icahn takes large stakes in companies, then uses his influence to push for changes that will increase shareholder value. In 2006, Icahn made waves by taking a large position in Yahoo, pushing for management changes and strategic shifts. His reputation as a corporate raider was built on his ability to force companies to maximize profits, sometimes by demanding asset sales, restructuring, or leadership changes. Icahn's most famous move came when he targeted eBay in 2008, arguing that its subsidiary Skype was undervalued and should be sold. After a tense battle with eBay's management, Icahn succeeded in pressuring them to divest Skype, which led to significant profits for shareholders. His strategy is simple yet effective: take control, demand improvements, and force companies to unlock their hidden value. Icahn's approach made him billions and revolutionized the idea of what an investor could accomplish. Lynch's familiarity. Peter Lynch, one of the most successful fund managers of all time, built his wealth by investing in what he knew. His mantra, "Invest in what you know," helped him achieve incredible success as the manager of Fidelity Magellan Fund from 1977 to 1990, turning it into one of the best-performing mutual funds in history. Lynch believed that everyday investors could spot investment opportunities by paying attention to the products and services they used in their daily lives. He didn't rely on complex financial analysis or insider information. Instead, he focused on industries and companies he understood and believed in. One of his most famous investments was Ford Motor Company. While most investors overlooked it, Lynch recognized the company's potential as a leader in the automotive industry. He also invested in fast food chains like McDonald's, seeing their growth potential early on. Lynch's strategy proved that successful investing doesn't require insider knowledge or complex formulas, just the ability to spot opportunities in familiar places. Paulson's contrarian bet. John Paulson, a hedge fund manager, became a household name in 2007 when he made one of the most successful contrarian bets in financial history. While the rest of the world was riding the housing boom, Paulson bet against the U.S. housing market, a move that would make him $15 billion in profits. In the mid-2000s, the real estate market was booming, and most investors were heavily invested in mortgage-backed securities. However, Paulson saw the signs of an impending collapse. He believed the housing market was built on fragile foundations, with risky subprime loans inflating home prices. While many analysts were optimistic, Paulson's sharp analysis of the situation led him to take a drastically different path. He decided to place a massive bet against mortgage-backed securities by buying credit default swaps. These swaps were essentially insurance against the collapse of these securities. While the market remained optimistic, Paulson's hedge fund, Paulson & Co., continued to short the housing market. In 2008, when the housing market collapsed, Paulson's bet paid off spectacularly. As the mortgage-backed securities values plummeted, Paulson made billions while the rest of the world suffered massive losses. His contrarian strategy, which involved betting against the majority, turned out to be one of the most profitable moves in the history of hedge fund management. Paulson's success wasn't just about taking big risks. It was about seeing what others couldn't. He had the conviction to bet against the status quo, even when everyone else was convinced the housing market would keep rising. His story serves as a powerful reminder that sometimes the greatest rewards come from going against the grain and trusting your own analysis, even when it seems counterintuitive. Stay tuned for our next video, Insider Investment Tactics: What Billionaires Do That You Don't. Subscribe now and never miss out on exclusive insights that could change your financial future.